The currency swap market, main future, the oldest and the most creative sector of the swap market. This is not distinguished in market terms between the fixed rate currency swap and the currency coupon swap. There is no distinction in market terms between these two types of currency swaps because the only difference is whether the counter currency received payment is on a fixed or floating basis. In structure and result, the two types of swap are identical and it is a matter of taste or preference for one or both counterparties to choose a fixed or floating payment. When the dollar is involved on one side of a given transaction, the possibility to convert a fixed rate preference on one side to a floating rate preference on the other side through interest rate swap market makes any distinction even more irrelevant. However, for those who like fine distinctions, there is no tendency in the market to regard the fixed rate currency swap market as more akin to the long date forward foreign exchange market because when one is executing a fixed currency swap, one may often be competing with the long date FX market. And the currency coupon swap market as more akin to the dollar bond. Issuer compares the below label spread available in the dollar market to that available, say, through tapping the Swiss franc market. Most interesting sector of the swap market, whatever distinction one wishes to draw or not to draw between the two basic types of swap in the currency swap market. There are many reasons why this market is the most creative and therefore most interesting sector of the swap market. While still smaller than the dollar interest swap market, the currency swap market has great and perhaps even greater potential for growth than the dollar market, particularly in the light of the growth in local euro capital markets in a wide range or currencies, the primary and secondary sector. One can classify activity in the currency swap market into the same two basic sectors are the interest swap market, a primary and the secondary sector. In the currency swap market, the primary sector is the dominant across the yield curve and the key motivating force underlying this market are new money and hedging in that order. New money or the willingness to execute swap relate public or private financing in one currency to achieve a finer cost or enhance availability in another currency in the key motivating force behind the currency swap market. Particularly for banks, sovereign entities, such entities have had large capital and refinancing requirements in recent years. The capacity of any one mark, the euro-dollar bond market, to provide all of these requirements at the finest possible cost has been limited. Hence, many banks and sovereigns have been willing to approach the private and public debt markets in currencies for which they had no natural requirements, but which the swap market can use in order to reduce costs and or gain greater access to a particular currency which is required. Restructuring or hedging current debt portfolios, cash flow, or investment is clearly an influence of second order as comparisons to the influence of new money. The flexibility of loan repayment clauses and the fact that many corporate and sovereign entities had found their access to a wide range of securities market greatly expanded in recent years means that even the fundamental motivation of a currency swap is restructuring hedging. This would normally be proceed by an issuer first obtaining a cheaper cost of fund in the base currency through securities or near security transaction. The creativity from the market point of view, the driving force of the currency swap market is creativity. Structures in the currency swap market range from the extremely simple to the complex multifaceted, multi-counterpart transaction whose economics exist in the dimensions available only to the mathematician. One is limited in the currency swap market only by the problem to be solved, one's imagination, the skills of your personal computer operators, and of course the ability of your colleges to find suitable counterparts around the world at the right time and price. As opposed to the dollar market where a capital commitment has become increasingly important. The K in the currency capital commitment has become increasingly important. The K in the currency swap market is still commitment to create creative problem solving and development of a swap distribution system on a global basis, classic investment banking. Individual demands and supply interplay, warehousing in the primary market is not widespread due to the difficulty of covering the interest rate risk while the swap is in position. A swap arranger can cover the foreign exchange risk associated with booking open a position in a given currency, but oftentimes the arranger cannot cover against and movement in interest rate for that the currency or is forced to use generally poor surrogate cover. This is due to the fact that the currency swap rates generally move to the low of their own supply and demand and do not necessarily relate to, say, local government bond. Market where covered in some currencies can be obtained, particularly sterling and Deutschmark. But taking a position does not take place among a few selected players, and such market making is not done on a much wider spread basis versus capital market rates than in the dollar interest swap market. However, until better and more consistent relationship between swap rates and the available interest covered develops, position taking in the currency swap market will remain very much akin to long-date forward foreign exchange dealing and leads toward the classic arbitrage model of the swap market. The most important currencies of the swap market, the most currencies in the swap market in large order of the magnitude are the Swiss franc, yen, Deutschmark, pound sterling, and Canadian dollar. These currencies are popular in the swap market due to their low interest rate versus dollar and the relative use of excess by a wide range of issuers to private and public debt in the euro. In the domestic market of these currencies, many supranational and sovereign borrowers find their access to the debt markets of such currencies constrained versus their sometimes quite large requirements. And therefore, market is extremely active and frequent use of the currency swap market. Such entities either lend in their currencies and therefore covering matching asset with liabilities or are trying to diversify their debt portfolios. What from the dollar and the cost of the rise of that currency can be imposed in national budget. Dollar's domination even after so much development in the swap market. The domination of dollar continues, though this is also the fact that many direct currency combination continues such as yen, Swiss franc, the other high interest rate currencies involved in the currency swap market are viewed as speculative vehicles for aggressive debt portfolio. Manager or companies in the local market which would have to pay dearly for fixed rate debt. This latecomer account for the active use of exotic currency debt markets by prestigious international issuer. This has occurred recently in a number of capital markets in which the first few euro issues are complete at wide divergence to the domestic market rate. Thus, the swap which become available in this way have account for the presence of many high power issues. The quality image gained by such issues should on this market has gained acceptance for new market and hence fostered their growth in some the primary sector of this currency swap market. The dominate by new money consideration by issuer on the other sides by greater access to a select few low interest rate debt markets by often the same type of entities. There is, however, a greater diversity by type of participant in the currency swap market than the interest swap market with financial institution, particularly banks, playing a smaller role in the currency market and sovereigns, supranational and corporate playing a relative larger role than such entities do in the dollar swap market. Position-taking capital commitment is still less important than commitment to the creativity and distribution capacity among arrangers. While the currency swap market is highly competitive, there is still the possibility to beat your competitor by being smarter, quicker, and developing niches of special expertise in a particular currency. Highly opportunistic subsector. The secondary market is a highly opportunistic subsector of the currency swap market and judging by bankers' trust-owned activities in this market, the secondary market and currency swap is relatively larger in comparison to the primary market. Some of the experts are of the view that this is due to the given swap counterparty having two chances to win or interest exchange rate in a currency swap and that with the enormous volatility of the dollar. A chance to win big on an exchange rate play. Although the original motivation may be to create a currency swap, but the primary motive on the secondary market is to take profit before a currency move places swap into an unprofitable position. New breed of financial management. The secondary market phenomenon is an inherent part of the new breed of financial management which aggressively manage their cash flow and debt portfolios because they are judged by profits. The spreads tend to be relatively wider in the secondary currency than the secondary interest swap markets move quickly when an exchange rate breaks as the key to the level of profitability. The exchange rate affects the profitability of a swap reversal as so much that in case of exchange rate that excellent prices and highly attractive rates can be obtained in the secondary market. The reverser needs to move quickly to capitalize on his exchange rate gain. This may lead to the virtual wholesale shutdown of the primary market in currency swap. This is so because of the fact that many counterparties want to reverse up at the same time. Consequently, this will lead to substantial discount in interest rate on the secondary market versus the primary market. Position taking and market making. Unlike in primary market, the position taking and market making are very common in the secondary market due to the excellent pricing available in the secondary market most of the time. Like the dollar markets, sophisticate. Financial managers are aware that the credit risks are greater in currency swap. When the time comes to reverse a position, this sophisticated financial manager will make a market on the original transaction, the fixed rate currency swap. A fixed rate currency swap consists of the exchange between two counterparties of fixed rate interest in one currency in return for fixed rate interest in other currency. Following are the main steps to all currency swap. Number 1. Initial exchange for the principal. The counterparties exchange the principal amount on the commencement of the swap at an agreed rate of exchange. Although this rate is usually based on the spot exchange rate, a forward rate set in advance of the swap commencement date can also be used. This initial exchange may be on notional basis of alternative and physical exchange. The sole importance of the initial exchange in being either on physical or national basis is to establish the quantum of respective principal amounts for the purpose of calculating his ongoing payments of interest and the re-exchange or principal amounts under the swap. Number 2. Ongoing exchange of interest. Once the principal amount are established, the counterparties exchange interest payments based on the outstanding principal amount at the respective fixed interest rates agreed at the outset of the transaction. Re-exchange of the principal amounts on the maturity date. The counterparties re-exchange the principal amount established at the outset. This straightforward three-step process is standard practice in the swap market and result in the effective transformation of a debt raised in one currency into a fully hedged fixed-rate liability in another currency. The principle, the fixed currency swap structure is similar to the conventional long-date forward foreign exchange contract. However, the counterparty nature of the swap market results in a far greater flexibility in respect of both maturity periods and sides the transaction which may be arranged. A currency swap structure also allows for interest rate differential between the two currencies via periodic payments rather than the lump sum reflected by forward points used in the foreign exchange market. This enables the swap structure to be customized to fit the counterparty's exact requirements at attractive rates. For example, the cash flow underlying bond issues may be matched exactly and invariably. The currency coupon swap. The currency coupon swap is a combination of the interest rate swap and the fixed rate currency swap. The transaction follows the three basic steps described for the fixed rate currency swap, with the exception that the fixed rate interest in one currency is exchanged for floating rate interest in another currency by using the currency coupon swap. The benefit which can be obtained can be explained with the following example. Suppose an Indian corporate wished to enter a major leasing contract for a capital project to the B site in Japan. The corporate wanted to obtain the advantage of the funding through a Japan lease, which provided lower lease rentals due to the Japan tax advantage available to the Japan lessor. However, the corporate was concerned by both the currency and interest rate exposure which would result from the yen-based leasing contract. The structure provided by Hunker's Trust enabled the corporate to obtain the cost benefits available from the Japan lease, and at the same time convert underlying lease finance into a fully hedged fixed-rate yen liability. Under the structure, Bunker Trust paid on a quarterly basis the exact payments due on the corporate's yen-based Japan lease in return for the corporate paying an annual amount of fixed Japanese yen to Bunker's Trust. The amount for fixed Japanese yen payable reflected the beneficial level of the Japanese yen lease payment. The basis rates. A fast developing area in the international swap markets is the basis rate swap. The structure of the basis rate swap is the same as the straight interest rate swap, with the exception that floating interest calculated on one basis is exchanged for floating interest calculated on a different basis. The forerunner of this type of swap was the US dollar prime rate LIBOR swap. However, an even larger market has developed for the exchange for 1 month US dollar LIBOR for 6 months US dollar LIBOR, and more recently US dollar LIBOR for US dollar commercial payment at much finer rates than those available on the foreign exchange market. The availability of the basis rate swap market provides an excellent method for entities to arbitrage spread between different floating rate funding sources. More importantly, it's provided discrete and most efficient method for European entities in particular to stimulate the U.S. commercial paper funding market without the necessity of meeting the stringent use requirements for a commercial paper program. The illustrate consider the transaction structure by a banker trust which enable an European bank to obtain effective 30-day commercial paper funding by converting its 6 months US dollar funding base into 30-day commercial paper via basis rate swap. The counterparty to the transaction was a second European bank wishing to match its commercial paper funding program to its LIBOR assets. Swap risk and exposure. The great bulk of swap activity of date has concentrated on current choice and interest rate, yet this do not exhaust the swap concept applicability. As one moves out the yield curve, the primary interest rate swap market becomes dominated by security transaction and in particular the euro-dollar bond market. The advent of the swap market has meant that the euro-dollar bond market now never closes. Due to the interest rate levels, issuers who would not come to market because of high interest rate now do so to extent that a swap is available. Indeed, the euro-dollar bond market owes much of its spectacular growth to the parallel growth of its swap market. The firms that now dominate lead management rules in the euro-dollar bond market all have substantial swap capabilities, and this trend will continue. One exception is seen at the beginning of the market for equity swap, an exchange of coupons on some bonds for dividends on some equities or an index instrument thereof. Capital appreciation also may be included on one or both sides of the swap. The purpose is to earn equity returns when the investor deems them promising, but without the transaction cost of liquidating an existing bond position or building an outright equitized position, while also providing the complication of unfamiliar local market and the time and trouble of stock picking if the index will suffice. Equity swap and ended all swap further may be enhanced by option futures customized to the interests of the creditworthy. Sophisticate. Investor commodities are another fertile area for swap in view of the limited scope of price protection alternatives. There is no modestly growing swap activity in the principal non-ferrous metals such as copper and aluminum, and rather more in gold based partly on the advantage of the swap investment for protecting long-term project financing vulnerable to the price instability. The major focus, however, now lies on petroleum and petroleum products. This is the physical commodity sector for most critical to find economic uses. Since the mid-1980s, this sector has become one of the most heavily traded in the cash and futures market worldwide. Essential for reducing swap risk. There are certain precautions which are suggested to the taken to reduce the swap risk. They are as follow. Number 1, undertaking more stringent credit analysis and use greater care in selecting counterparties. This provides the best insurance against the swap risk. Having a financially strong counterpart not only minimize the chances of default, but also facilitate the transfer of a swap for either profit or lack of need, or both. 2. Master agreements. This stipulate that all swap between two parties are cross-default to each other. Default on any one swap triggers a suspension payments on all other covered in the agreement. Such arrangement normally presuppose frequent transaction between the parties, they also are most effective in reducing exposure when a balance exchange in swap position between paying and receiving fixed rate flows, and between national principal amounts and maturities. Number 3. Collateralization. Collateralization with marketable security has become an essential feature of swap with dubious credits. The right to call can be mutual, which normally applies only in one direction, depending on the relative strength of the two parties. Number 4. Better documentation. More protective documentation in swap agreements can provide trigger points for remedial action in advance of actual default. User could require, for example, that the various tests of financial condition found in credit agreements can provide trigger points for remedial actual action in advance of actual default. User could require, for example, that the various tests of financial condition found in credit agreement are incorporated into swap contract. Number 5. Net settlements. To minimize risk, a swap user is well advised to insist on settlement of all payments on the same day and on a net base. A payment lag can leave a user vulnerable to loss of its counterparty defaults before the corresponding payment has been made. Review questions. Number 1. In currency swap, counterparties exchange the same sum at the beginning and the end of the swap period. Explain how this practice relates to the custom of making interest payment during the life of the swap agreement. Number 2. Why is an interest rate swap simpler to a future contract? Number 3. How can an interest rate collar be created? Number 4. In a currency swap, both the financial principal and the periodic coupons are exchanged. Why is this unnecessary in an interest rate swap? Number 5. What is a swaption? Number 6. Explain how you would value a swap that is the exchange of a floating rate in one currency for a fixed rate in another currency. Number 7. Explain the difference between the credit risk and the market risk in a financial contract. Which of the risks can be hedged? Number 8. Explain synthetic future and distinguish between the future contract and option contract. The interest rate swap lesson 4. Lesson outline. Introduction. Primary market, secondary market, reason for slower growth. After reading this lesson, you would be able to understand what is interest swap and the meaning and working of the primary market, the meaning and working of the secondary market, reason for the slow growth of the market. Introduction. The basis structure of interest rate swap consists of the exchange between two counterparties of fixed rate interest for floating rates interest in the same currency calculated by reference to a mutually agreed national principal amount. The principal amount, which would normally equate to the underlying asset or liabilities being swapped by the counterparties, is applicable solely for a calculation of the interest to be exchanged under the swap. At no time it is physically passed between the counterparties. The counterparties are able to convert an underlying fixed rate asset, liability, and vice versa through this straightforward swap structure. The majority of the interest rate swap transactions are driven by the cost saving to be obtained by each of the counterparties. These cost savings are substantial and result from differential in the credit standing of the counterparties and other structural considerations. Generally, investors in fixed rate instruments are more sensitive to credit quality than floating rate bank lenders, according a greater premium is demanded of issuer or lesser credit quality in the fixed rate debt markets than in the floating rate bank lending market. Lending market. The counterparties to An interest rate swap may therefore obtain an arbitrage advantage by accessing the market in which they have the greatest relative cost advantage and then entering into an interest rate swap to convert the cost of the funds so raised from a fixed rate to a floating rate basis or vice versa. This ability to transfer a fixed rate cost advantage to floating rate liabilities has led to many high-quality credits issuing fixed rate Eurobonds purely to swap and obtain in many cases sub-LIBOR funding. The use of this structure in a fixed rate Eurobond issue enabled the issuer to obtain substantial funding at points below LIBOR. This most attractive or rates is made possible by the careful timing of the euro issue to ensure its success at the finals of rates and the use of exact hedging in the deferred swap accrual date to ensure the best possible swap terms for the issuer. The counterparty to the swap may be a combination of banks and corporate clients. The bank may want to hedge their fixed rate income into floating rate return that fully match their floating rate liabilities in order to alleviate interest rate exposure. The corporate clients may want to hedge their floating rate binding into fixed rate liabilities for a size and maturity unable in direct fixed rate debt market. Acting as principal, the intermediary may be able to provide both the banks and its corporate clients with swap terms to meet their exact requirements and then subsequently lock the Eurobond issuer in an opposite swap when the Euro market was most receptive to the issue. Interest rate swap also provide an excellent mechanism for entities to effectively access markets which are otherwise closed to them. The ability to obtain the benefits of markets without the need to comply with the prospectus disclosures, credit ratings, and other formal requirements provides an additional benefit. Accepting the yield, the primary interest rate swap market is dominated by securities transaction and particular the euro-dollar bond market. This market segment is very large. It is estimated that the sum 75% of all euro-dollar bond issue are swapped and the dollar fixed rate euro bond market is currently running at an annual rate of $50 billions plus. The euro-dollar bond market never closed due to the interest rate level. Issuers who would not come to market because of high interest rate now do so to the extent the swap is available. The firm that now dominate ledge management rule in the euro-dollar bond market all have substantial swap capabilities and this trend will continue. Pricing in this segment of the market is exclusively related to the US Treasury rates for comparable maturities and it's marked by the relative stability of this spread by comparison to the short-term market. The size of the Eurobond issue and the oversupply of entities able and willing to approach the Euro market to swap into floating rate fund. Most major houses in the swap market now enter in the swap agreement with an issuer without counterparty on the other side. The warehousing activities normally heads in the US Treasury of financial future market, leaving the warehouse manager with the spread risk or the difference between the spread at which he booked the swap with the issuer and where he managed to find a matched counterparty. The relative stability of spread and positively sloped yield curve have allowed the market to function reasonably well on this basis with only occasional periods of severe oversupply in any particular maturity. The major houses tend to spread their inventory across the yield curve to reduce risk to ensure ready ability for a given maturity for particular clients' requirement. Bids for bond related swap tend to differ between the major houses by only a few basis points. The swap market is quite efficient in prices Given the few houses who deal in bond market sites and maturity, hence, a premium is placed on creating bond structure which offer the fixed rate issuer and lower cost and therefore a better spread LIBOR. Apart from creative bond swap structure, the key to successfully operating in this segment of the market for the bond swap arranger has been development of a highly refined sense of timing for the underlying issues. While finding a window in the euro-dollar bond market has always been the sine qua non for a successful lead manager. With the advent and development of the swap market, the focus of the potential lead manager has shifted from an investor window to a spread window. Given that the long-term swap market operates on a relatively stable spread level versus US Treasuries and the euro-dollar bond market is notoriously volatile versus treasuries for different types of issuer. A similar premium to the creativity applies to the large manager who can locate spread window for a particular type of issuer. This creativity and search for a spread window has sometimes led to mispriced and or virtually incomprehensible bond structure bond more often than not bond. Swap structures so create have provided value to both the Eurobond investor and issuer. However, it is clear that below LIBOR spread available to issuer have declined as the market has become more efficient in pricing the relative value of a given swap. At the outset of the market, AAA issuer could reasonable expect to achieve 75 to 100 basis points below LIBOR on the bond swap under current market condition. This same issuer might expect only 20 to 30 basis points below unexplained vanilla bond swap and then maybe issuer particular commercial banks now find it's more cost effective to approach the floating rate note market than the bond swap market. The lower spread available had gone almost entirely to the benefit of the fixed rate player. Intermediaries had seen their profit margin reduced to a very substantial degree in the primary market. This reduced profitability and lower spread available has led in turn for most bond swap arrangers to attempt to put potential counterparties in direct contract with each other and eliminate the intermediation of a commercial bank. This is most often a very difficult process due to timing and credit consideration, but there is no strong incentive now among all parties concerned to see whether a direct right is possible on a new issue. The long-term secondary market for interest swap is a highly opportunistic segment of the market. As interest rate fluctuates, a fixed rate provider or taker may find that a substantial profit can be realized by reversing the original swap or canceling the original swap in return for an upfront cash payment. Several reasons can cite for the slower rate of growth of the interest swap market. The few of them are explained below. Number 1, banks executing fixed rate bond issues have presented a large portion of the provider side of the swap market. Most of the banks execute bonds swap to gain long-term floating rate funding for their long-term floating rate funding for their long-term floating rates loan and therefore have no reason to reverse. Number 2, the odd dates throw for off by swap reversal are often difficult to close on the market and thus what appears to be an interesting price on spot basis may become substantially less interesting when the odd dates are taken into account. Number 3, many swap intermediaries do not make markets to their clients with whom the original swap were written. In this case now, the only option available is to execute a mirror swap for which upfront cash would be difficult to obtain and entails a doubling of credit risk for reverse. Sir, the market risk may be associated with a fixed flow. There is also risk associated with the LIBOR side. An additional potential risk can be assumed depending on the structure of the swap when counterparty receive fixed payments semi-manually and pays LIBORs semi-annually. Potential risk is minimized. Despite the problems explained above, the long-term secondary market has shown goods and several houses had sponsored the growth of this segment commitment of capital, personal and system capabilities to market to making and long-term swap. Review question. 1. What do you understand by interest rate swap? Number 2, what is primary market? Number 3, explain the main feature of the secondary market. Number 4, examine objective of the interest rate market. Number 5, what are the reasons for the slow growth of the swap market? Number 6, explain with an example the working of the swap interest swap market.